So you mentioned a really interesting point, and so I guess the question before, where you're talking about how, I guess with the T bill, and if we look at the 60/40 portfolio, it's really been a benefit. It's really benefited over the past 30 years, but there's the risk at the moment of, with inflation remaining high, yields remaining high and increasing, potentially the value of the bonds could go down. So do you see the people starting to maybe diversify more, just going away from these bonds into precious metals as a way to, as you said, sort of balance their portfolio a bit more?
Interestingly, not yet. I think we've been schooled in the last 40 years, which I think were the most benign economic period in human history, not to be afraid. Interest rates, both nominal and real, fell for 40 years. The benefits of globalization, the benefits of inclusion in the workplace, the benefits of demographics, all of those things conspired to make the last 40 years a wonderful time to be an investor and to be a consumer. I'm not saying that the world's going into a hell in a handbasket, but I think we're entering a period of time that's more challenging. When your expectation of the future is set by your experience in the past, our experience in the past has been pretty unchallenging. And I think as a species, or at least as investors, that we're less prepared for the future than we ought to be. Many times when I give talks like this, particularly to people of your generation who haven't really experienced the trying times that might have existed, say, in World War II or in the period of the 1970s, there is a sense that things only get better. And I suspect in the very long term, that's true. Things only get better. But there is also, I think, less fear, less experience. As an example, a younger audience might question my view of inflation. They may say, well, the CPI stated rate of inflation is barely at 3. What's the concern if I'm getting 5% in a treasury security? I would suggest that the CPI is a flawed measure of inflation. It's a consumer price index. It is, quote, hedonistically adjusted, which means that if the big thinkers that compile the index think that an item is more valuable than it used to be, that they adjust its relevance to the index. But much more importantly, Anthony, the CPI doesn't include tax. The largest expense suffered by most households in the developed world is tax. And the idea that they don't include tax in what purports to be a cost of living index is borderline fraud. It's insane. The way I informally calculate the depreciation of my purchasing power in US dollars is that the depreciation of purchasing power, including tax, means that my savings are losing purchasing power at about 7% compounded annually. The idea then that I'm happy about receiving a 5% yield in a currency that's declining in terms of purchasing power by 7% compounded means that my return on capital employed in savings is a minus 2% a year compounded, not particularly attractive. And you put your finger on really the death trap, which is to say the ability of portfolios for pensions and endowments, as an example, to meet their obligations 25 or 30 years hence. There's two problems there. The yield that they're getting from their long-term debt instruments is insufficient to maintain the purchasing power at the same time that the rising interest rates are lowering the capitalized value of the investments that they already have. So as an example, a university endowment that bought treasuries 3 years ago to yield 3% finds themselves now underwater in terms of the capitalized value of the corpus of their endowment, down by 30%. At the same time that the income is insufficient to maintain the promised payouts. This, for your generation, should be their primary concern.